We've been taught to put money in the bank, but let me ask you this one simple question. Are you in control of your money in your bank account? When we do this specially designed whole life insurance policy, because that is the life insurance that we use, it is the only life insurance that works for the infinite banking concept. We have to design and engineer that policy so that it works for your needs and goals. Welcome back, everybody, to another week, another wealth webinar. Super pumped to have you here today, because today we are going to embark on something we've never done. Matter of fact, let me kind of give you a little summary of today. Today we're going to do something we've never done because we've never known how to do this. We've never been able to do this. Thanks to Craig and his spreadsheets and mathematical wisdom, we are able to do things no other company can do. We are able to mathematically prove every single thing we show. So now that's what we're going to do today. We're literally going to mathematically solve a myth. I don't know if it's so much a myth, but let me ask you all this. Well, first off, before I even ask that, how many of you are here for the very first time? Put I in the chat. I want to see who our newcomers are, because this is always the funnest part about this show. Every single week we do this show. Look at that. We got Nicole. Holy cow, they're coming in hot and heavy. We got Nicole, Maria. I'm going to butcher that name, but Dejudi? I think I might have got that. Caleb, we got Rosalind, we got Angelina. That's a pretty name. Charlotte, Jermaine, William. Look at this. Christian Hayward. That's a cool name. Christian, well, Christian said LOL. Loudney, Thelma, David, Brandon, Craig. I'm new Craig. Mario, Quinn. Quinn is here for the first time. Quinn was here nice and early. I love it. And Sharonda, so awesome. Welcome, every single one of you. Thank you for being here for the first time. And I can tell you, it probably will not be your last. We do this show every single week. Same time, same place, but the show is about to get better because we do 3 shows every Wednesday. We do WTF in the morning at 9:30. It's kind of a wild, crazy show. If you don't like people swearing, don't go to WTF. But if you like rants and you like arguments and you like cool stuff about the economy and the markets and where things are going, you'd love that show. This show is completely educational. We literally go above and beyond on this show to dive deep into how to take back control of your money and how to become your own bank, which is today's topic. And then at 4:30 every Wednesday, we also do Ask Me Anything. And we were actually asked, it's kind of funny, Stephen was super pumped. We were asked last week that this week on Ask Me Anything Happy Hour that we actually have a happy hour. We used to always have a cocktail when we were doing it, and then we kind of got away from that, and now our audience is asking us to come back. So that's what we do every Wednesday. But we also do a live every Monday, Money Club Monday. Stephen does that show. We do Take Back Control Tuesdays, which is the IBC. It's literally teaching people the infinite banking concept. The best training for IBC is that, Take Back Control Tuesdays, every Tuesday. I think we might have a show Thursday. And then Friday, I think, is the only day we don't have a show. But then we've got this awesome thing. And actually, sorry, I'm doing this right in the beginning. I'm just getting excited. If I can show you this. We are relaunching what to me was always one of the best things we ever did. It's called Money School TV. Think of Money School TV like a TV station, okay, where every single day there are different things showing, and you can come back and watch your favorite sitcom, your favorite show, or you can watch a new show. You pick and choose. There's a bunch of pre-recorded shows that you loved from back in the day that you just want to go back and watch again because you want to learn. We do lots of live stuff here. We do a lot of coaching here, and there's a ton, I mean, a ton of information. We call it MSTV, and it is literally one of the best financial sites in existence right now. It doesn't just cover IBC, it covers everything from stocks and options. It goes into mindset. It goes into, heck, you want to know the best morning rituals to get your day off to a good start. It goes into real estate, private lending, all of that, and then more, and live shows that you cannot get out there because this, unfortunately, is not free. All those other webinars I told you are free, but MSTV has a cost. But we deliver for that cost. Now, if you're ready, I can tell you what the whopping cost is for MSTV. It's a whopping $19 a month. That's right. It's a real bank buster. Or you could go in and do $190 a year. So folks, literally, 2025 is the kickoff, the relaunch of MSTV. We are going to be spending a ton of time inside MSTV, members only. So you got to have the green jacket that says MSTV on the patch. We should do that. We should actually make members jackets. And that's how you're going to do it. 19 bucks a month. You can just go there. We'll put this up in the chat if anyone's interested. Not trying to sell you anything, but listen, I'd be remiss not to tell you about TV. So with that being said, I'm going to stop that. But anyway, there's tons of stuff. You can kind of go on there. We've had members in MSTV since I think 2020, if I'm not mistaken. 2020 somewhere is when we launched. And we have had members that started then that have never left. And we're hoping all of you will be in there too. But here's what we're going to go into today. Okay. Now that I know there's a bunch of you here for the first time, let me first explain what the infinite banking concept is, okay? It was founded by R. Nelson Nash back in the late 90s. You know, somebody today was saying, you know, you think you came up with something great? I'm like, hold on, I didn't come up with anything. This is a comment on a YouTube video. R. Nelson Nash pioneered this concept. Notice how I didn't say a product, I said a concept, this process in the late 1990s. And all this process does is allows folks like you, me, everyone else to take back control of the banking functions in their life. Let me give you an example. So everything that you finance in your life, just think about all the things that you have gone to a bank or a finance company and you have financed. Most people have cars, houses, boats, ATVs, dirt bikes, all that stuff, furniture, appliances. You financed all that. Imagine, or just in your mind, go through and think of how much money do you spend every single month in monthly payments going to things that you have financed. Then once you get the number at the end, you'll probably gasp. Some of you might even throw up. Some of you might just straight up faint. But just imagine that you wrote that check every month, just like you do today, but you wrote the check back to yourself. And every month you did the same thing. You never leaked any interest to any financial institution except for your banking system. Everything was paid back to you. You recaptured all of that interest you're giving away. Plus, every dollar you put into your banking system, you got paid interest and dividends on that money every year, whether the money was in the account or out working for you, buying cars, paying off debt, buying houses, real estate, lending, all that stuff. That is what the infinite banking concept is. It is a process, a banking process. I'm not going to draw it on the board today, but here's the thing. That process does involve changing one thing. And that one change is where your money goes first. You see, here's the thing that R. Nelson Nash found out, and he wasn't the first to use this yet either. This actually goes all the way back, and I got a video on my YouTube, hence why I keep asking you to subscribe to my YouTube channel. There's a video, the history of infinite banking, and it takes you all the way back to the Rothschilds, the Rockefellers, the Morgan family, the Stanley family. It goes back to like how Walt Disney used it, how Ray Kroc used it. Now, let me ask all of you a question, and there's some new timers here, so let's see if you can all get this right. And thanks for being here, Gal. How many of you can tell me what business is McDonald's in? Like, what is their business? Who can tell me? Jim Harbaugh? Yeah, actually, everybody knows Jim Harbaugh. That's right. So as those comments come in, all right, keep them coming in. Let's see if anyone gets it wrong. Isn't that funny, Craig and Steven? Did you notice how nobody said that they're in the fast food business? Nobody said they're in the hamburger and French fry business. Nobody said they're in the food business at all. What business did they say, Craig?
Real estate, but I was thinking they're in the obesity business.
That is probably save that one for so we'll go in there and we'll look at the stats on the McDonald's and how many folks they have helped obtain obesity. But nonetheless, McDonald's is a real estate company. So when Ray Kroc was told, you're in the wrong business, you're not a burger business, you should be in the real estate business, he had to fund that business. Well, I'm not going to give you the rest of it, but how did he fund McDonald's becoming a real estate business? They own more real estate than just about any other company that exists. Well, what you're going to learn today is literally the fundamentals of what Ray Kroc figured out, of what Walt Disney figured out when he couldn't get financed through a traditional bank for his dream, which is Disneyland. So he then used his own banking system, a product. He changed where his money went first, because in order for any of those folks to do what we're going to teach you today, they could not. There's one thing they could not have done. They could not have had all of their money in a traditional bank, because if they had all their money in a traditional bank, the bank makes the money. That's the business a bank is in. A bank is in a business of you going in and depositing money, which every single one of you, all 132 of you on here right now, you use a bank, myself included. I have several bank accounts, lots of bank accounts. We all use a bank. We make money, we put it in the bank. We spend money from the bank, we put more into it. That's how it operates. We've been taught to put money in the bank, but let me ask you this one simple question. Are you in control of your money in your bank account? Put it in the chat right now. Are you in control of the money in your bank account? Darren said, nope, nope, nope. Come on, somebody's got to say yes. Holy shit. Can someone just humor me and say yes? Craig said yes.
Somebody said ish. So I think there's a yes and a no in there.
There we go. Nicole's going to play along and be like, all right. Nicole's like, I know they're not, but I know I'm not. But all right. So if somebody said to me that they were in control of the money in their bank, I would say, how come the bank doesn't have to call you and ask when they want to lend your money out? They would need your permission if you were in control of your money. But I got a smart group here. Even all the new folks that are here for the first time said, nope, we're not in control. But that's what I mean. The bank's in control of your money. So because the bank's in control, the bank makes the spread. The bank controls the money. The bank is making money on your money. And all they're doing is giving you scraps. They're giving you a couple points, a couple interest, 3-4% interest rates, about the most you can get today in banks. You know how I know that? We have another company, shameless plug. Sorry, I'm giving you all these plugs today. We have a company that will be coming online in the next 60 days called PMC Wealth. Okay, PMC Wealth is a registered investment advisor. That's the world I used to be in, right? The financial advisory world, but we're doing it different. I color out of the box. When I'm teaching my daughter how to draw pictures, I'm like showing her, make sure you color outside of the lines. Get creative. That's what we did. We took the broken financial advisor model and we fixed it. And we did that with a company called PMC Wealth. Now, I'm not going to get into PMC Wealth today. You're going to hear a lot about that in the future. But here's what we do at PMC Wealth, better than just about anybody: cash management. What interest rate are you getting on your FDIC bank accounts? The answer is not enough, because you're only going to one bank, maybe two banks, and trying to find the highest interest rate. How many of you, by show of hands, how many of you every single month sit down, go online, pull up every bank in the country and look at what banks have the highest interest rate, aggregate them together to get the best blended interest rate, and then move your accounts every single month just to get that highest interest rate? Who is doing that right now? Crickets. None of you. But what if you didn't have to do that and you still could get the highest interest rate out there? What if you could literally have access to 1,000 banks and you had access to the highest interest rates available amongst those 1,000 banks, and every single month that was the return you got? That's what PMC Wealth does. And it is available to everybody. There are different levels of it. It is absolutely what people need. And the investment advice to go along on a fee-based retainer model, not a fee-based AUM model. So your financial advisor wants you to roll all your money to them. They want to control it, and they want to charge you a percentage on all of your money. We don't like that. I like attorneys. When I need an attorney, just like everybody else, you pay a retainer, you buy hours from that attorney, and basically, here's what I need. I need an operating agreement for my company. How many hours is that going to take? Hour and a half. Great. That's $300. You know what your cost is. That's what our advisory will do. Anyway, sorry, I went too deep down that. Getting out of control today with this stuff. I'm just so excited. So back to IBC, the infinite banking concept. We cannot use someone else's bank because they're in control. So we got to create some system, some place where we can put our money. Now, most of you already know what this is. It is the life insurance industry. They're not a banking institution. Life insurance companies operate under a completely different set of rules than banks do. They're not bound by the rules that a bank are. They're not, none of that. And also life insurance companies, and this isn't me telling you this, folks. This is the Rockefellers, the Rothschilds, the wealthiest families throughout history. They've always known life insurance companies are the most sound financial institutions in the world, period, bar none. And the reason for that is quite simple. They invest for the long haul. They don't take risks like banks. They don't go out there and stick their nose out just because they think they can make more money. They are in it for the long haul. And you know why? They're insuring your life. So they got to be in it for the long haul. They got to not just have money today or next year or the year after. They got to have money for your entire life and every person they insure. So therefore, they got to guarantee that money will be there to be paid out the day you graduate and go on to heaven. But you see, what the wealthy families found out is they found out, hey, listen, I know I can put money into life insurance and it's going to protect my family. So that's great. My family's protected. I love my family. I want to leave them in a better place. But there's this other side of it where we can give you our money. You will pay us interest and dividends because you are a mutually owned life insurance company. Therefore, you don't have stockholders. You just have me, the policyholder. So you'll pay me a guaranteed interest rate plus dividends. And because the IRS code was written probably by the same damn people that had money in whole life, probably a true statement. I can't confirm nor deny that, but I would have to believe that is why we have these beautiful tax advantages within life insurance that we do today. It only makes sense that back in 1913, when the IRS was created and the Fed was created, the same two people did the same two things. And guess where their money probably was? I already told you, Rockefellers and the Rockefellers and the Rothschilds had their money in life insurance. Lots of money in life insurance. And still to this day, you don't know how much the Rothschilds or the Rockefellers have because it is private. So they decided that insurance companies were more stable, and they changed one thing. And that was where their savings went first, which is what you may want to consider after seeing today. But now it gets complicated. So we understand in order for you to be your own bank, it takes one change, that is changing where your savings, not all your money, your savings goes first, and then applying one step, which is the infinite banking concepts, the process, which is a banking process. Very simple. I'll draw it for you in 30 seconds in a little bit. But when we do this specially designed whole life insurance policy, because that is the life insurance that we use, and the only, just let me be very crystal clear to all of you, it is the only life insurance that works for the infinite banking concept. I don't care what Pace Morby says. I don't care what Curtis Ray says. Sorry, I'm calling him out by name. I don't care what any of those folks say. IUL, Index Universal Life, is not a product that works for the infinite banking concept. So if any of you are thinking, oh, this must be that IUL stuff, absolutely not. It doesn't work. And that's not even me telling you that. That is economics. That is mathematics. That is the infinite banking practitioners doing lots of research, researching all the life insurance products to say, this is the only one that works. The good old-fashioned whole life insurance policy that's been around since the beginning of the life insurance industry is the one we use. But we don't use a life insurance, a whole life insurance policy off the shelf. We don't just go into the life insurance company and be like, hey, you got any of that life insurance? Oh, cool, here we go. Grab that box and just say, all right, this is the one I need. No, we have to design and engineer it. Now, let me pause and transition here. Think about cars. All of you drive some type of a car. Now, let me ask all of you, is a Ford Focus a sweet-ass car? You can be honest. How many of you think a Ford Focus is just the cat's meow of cars? Anyone? Shane's like, nope. Shane's like, you should get a Honda Pilot. I'd say that's an upgrade from a Ford Focus. All right, so
if you put one of those spoilers on the back, it can look pretty sharp.
I'm going to get there. So what we're talking about is a Ford Focus that you'd go into the dealership and you'd buy. It's not a sexy car. It's not a fast car. It's not an exciting car. And somebody said, I had one and I hated it. Who said that? Lucy said that.
Lucy.
And everybody pretty much agreed it's not a cool car. But now let me ask you this. You ever hear of a race car driver? His name was Ken Block, the late Ken Block. He passed away. But he was probably, in the world, the most famous and probably one of the best rally drivers. And also, I would call it, I don't know, he created this whole thing, the Hoonigan, but probably the most unbelievable car driver of all times. He could do things inside of a car that no other human ever was able to accomplish up to that point. But what kind of car did he drive during his career? Craig, what kind of car did Ken Block drive in most of those awesome videos that we've all seen?
Well, I believe it was a Ford Focus.
It was indeed a Ford Focus. But that Ford Focus, that was cool. That thing would go 130 miles an hour sideways in full control. It would go 0 to 60 in like 2-point-something seconds. It was just awesome. And it was all-wheel drive, and it did everything, including jump over rivers. That car was amazing. But wait a second, it was a Ford Focus. We just agreed a Ford Focus is the worst, but then Ken Block, one of the most awarded best rallycross drivers ever, drove a Ford Focus for most of his career. What's the difference? Craig, what happened to Ken's Ford Focus that made it so miraculous compared to the regular shitbox Ford Focus? What was so amazing about that?
Here's what happened. It was specially designed and engineered to solve his problem, which is to go fast, sideways, flying over rivers, and all sorts of other cool stuff.
Does everybody agree with that? That's all that they changed in that Ford Focus is design and engineering. It was done and designed for that purpose, and it made that Ford Focus really cool. You probably can't buy one of those. So as long as you can agree, now let's transition back over to this boring product called a whole life insurance policy from a mutually owned company that pays dividends. We have to design and engineer the policy contract because it is a contractual engineering. We have to design and engineer that policy so that it works for your needs and goals. Notice how I didn't say needs and goals. So it works for your needs and goals. Now, we got 145 people on here, and there is not one of you that is identical. Not one of you has the same needs. Not one of you has the same goals. Not one of you is living the same life. It's impossible. Maybe similar, but not the same. So therefore, we could all agree that no one will have the same policy design. Because if your needs and goals are all different, your ages are all different, your health conditions are all different, your premium deposits and your savings that you put in are all different, then none of you would have the same policy. So therefore, what we need to now figure out, and this is what we're going to mathematically show you today, is what is the best policy design? Like what would be, if we just had to kind of round it out, we'll take 4. Let's say we had to pick 4 designs to start with. Because listen, like when a race car is built, it starts with a base. And let's just say there was 4 cars, and all of them were going to be turned into a race car through design and engineering. We all start with a base. So we're going to start with something like a base, and we're going to build on that to make the race car we want, the specially designed and engineered whole life. So each one of those is going to be built differently because one is going to be a NASCAR, one's going to be an F1 car, one's going to be a rallycross car, and one is just going to be, I don't know, like a cup car. All of them started with the same base, but they were all modified differently to accomplish a different need and goal. That is exactly what we're going to talk about today, but we're going to talk about it for your needs and goals. So if I just had to ask real quick, just limited knowledge, even any of you that are here for the very first time, oh my God, look at Shane, the caffeinated beast. Look at some of you have watched too many of my YouTube videos. I have done videos and very popular videos on YouTube that show how to design an IBC policy. And if any of you want to watch them, it's called How to Design an IBC Policy. Make sure you watch the updated one because the rules changed in 2022. But today, we're going to build on that. And I normally would do this in a YouTube video, but we decided to do it in a wealth webinar. We're going to build on that. And we're going to say, okay, so if we've got these 4 bases and we've got these 4 designs, I want all of you right now to tell me, just with limited knowledge you have, what do you think the best design would be? And actually, hold on, let me give you a little bit more. Some of you are just chomping at the bit ready to do this. If there was one design that paid the absolute lowest commission to the agent, let's just say that's the 90-10. Okay, that one pays the least amount to the agent. So therefore, you would think that one's maybe the best. And there are a lot of people out there that think it is. And then there's another one that pays more commission to the agent. Which one do you think would be best? Put it in the chat right now. I love it. Caffeinated Beast is the best. Now, many of you don't understand what the Caffeinated Beast is, but it is quite amazing. Anyone? What would you all think? $1 under MEC. That is, holy shit, that's Brent, that's probably the best answer anyone could ever give.
Brent's been listening to us quite a bit.
Has he? That's phenomenal. Like that blows me away. And I love what Tess said too, the one that meets your needs. So Jermaine said 60-40. That's the Nelson Nash, okay? Because that was Nelson Nash in his book, Becoming Your Own Banker. That was the base. That was the one he only talked about. Romaine said 50-50. Caleb said 50-50. Depends on your situation. Deborah is 1,000% correct. Now, the unique part is you see Jermaine saying 60-40 and Romaine is saying 50-50 and Caleb saying 50-50. That might be the right design for them because they probably have already done it if they're putting that in here. But what used to happen is a lot of people said the 90-10 is the best because it pays the least amount of commission. So therefore, I have the most cash value. Now, I am not confirming nor denying that. I'm not saying any of these designs are the best because as some of you alluded earlier, the best policy design is the one that solves your problem. Let me repeat that. Your problem the most efficient way. So when we talk about the caffeinated beast and the Nelson Nash, we talk about the Slayer, and we talk about all these designs, just know that's great knowledge, but there is no one of those that works better than the other. There is just one of those that works better for your particular needs. And what we're going to do today is literally just like a race car. What is the first thing when you see a race car that some of you want to do? I know me and probably a lot of you on here, you want to look under the hood, don't you? When I see a race car, I want to see what's under the hood. Like, what do they got under that hood? Like a 457? What do we got? 454? Really, that's a 4-cylinder in there? Like, when I first learned that F1 cars and Indy cars are a 4-cylinder, I was severely disappointed. I'm like, oh my God, you got to be kidding me. You know, I thought these were like V12 twin turbos, and you're telling me this little son of a bitch is a 4-cylinder? Man, it just really, really hurt. But anyway, again, that 4-cylinder is the best engine for that particular need and goal. And they have found that out because they used to use V12s, then they used V8s, then there was 6 cylinders, now the 4-cylinder. Anyway, a lot of analogies in there, but what we're going to do today is we are literally going to go through and just show you some really cool things we have been able to find mathematically. So Craig, do you want to pull up the slides here? And I want
Yeah,
to...
we can do that. The other thing I was just kind of thinking about as you've been sharing with the cars is our team is almost like a speed shop where you can take your car in here and we're going to customize it. We're going to make it a race car. We're going to make a dragster. We're going to make a track runner, you know, whatever it's going to be. But I was also thinking that in terms of, you know, back in the day when you were an advisor, Chris, you went in and probably had tailored suits, didn't you? You probably had someone kind of pull in the chest a little bit and lengthen the pants.
Absolutely.
One of the things that's challenging is people will hear stuff out in the interweb and find out, well, hey, 90-10's best or 60-40's best. But the way that kind of feels on our end is that we're the tailors of making these really nice suits. And someone comes and says, hey, I heard the 32 waist, 32 length pant is the best thing I can have. I'm like, well, you weigh 250 pounds, you're not going to fit in these pants, right? So all these things that we're talking about is just customizing, the ability to customize, right? That's what we're talking about.
Let me say one other thing. I don't mean to cut you off. This is so good.
Yeah.
Some of the folks on here are old enough, and I know you and I are. Do you remember rayon? Remember the fabric rayon? I think that's what it was called. Back in like the 90s, we all had rayon shirts, super flowy, kind of like silk, but cheaper. You remember that? Nobody's wearing rayon anymore, but that was a fad back then. So there are also imposters in our industry that also have fads, and an IUL would be a fad. So sorry, I didn't mean to interrupt. I just thought of that just for a second. So go back to your custom tailored suits.
Well, no, it's just kind of, we have to think about, you know, what's your waist, your inseam. We have to figure out all those things. We can either we're a speed shop building cars or we're the tailors, you know, making the best suit possible. So it's just part of the design process and understanding. Yeah, Deborah, she's talking about the flammable rayon. Yeah, that stuff, you want to stay away from the cigarettes on that stuff. So.
Oh yeah, so fun. And yes, we certainly can customize your semis. So if your need and goal is just the long haul, boy, oh boy, do we know how to build that. And I love the speed shop analogy. I really do. And I think this title you came up with, Craig, is really awesome. Crafting effective IBC policies. Because that's really all it's about. And I loved the answers for some of the folks that said that. I mean, when we're doing this, it's not about the best. You know, it's not this one's better than that one. It's which one is effective for your particular infinite banking concept and need.
Right.
All right.
Let's get rolling here.
Get into it.
All right. And of course, we've all had the disclaimer as we joined into the show here. One extra disclaimer we want to put out there is just that all of the numbers that we're showing today are kind of based around certain assumptions, age, health. And the important thing is not to get so tied up in these specific numbers, but understand the process of how the premiums and dump-ins and term and all that stuff kind of relates together. So just know that your specific outcome might be a little different than what we're showing, but the principles are there. So when we're talking about building the best suspension for your race car, you know, yours might be a little different based on the kind of curves you're going to be doing. So just know that everything we're showing may be a little different than your specific situation, but the basis of it still stands. And one of the things we've talked about over and over so far is that, and you all agreed, that that the policy design really depends on what you're trying to do. And so for those of you that are new to our group, we have different tools where we can help illustrate and show how to solve your specific solution. So I'm just curious who's out there today for the first time that may be with us. Do you have consumer debt? Do you have credit cards? Do you have car loans? Do you have lines of credit? So if you're one of those people that have some debts to get rid of, just go ahead and throw I in the chat. I'm just kind of curious how many folks we have with us today that have that specific situation. And if you are saying I, one of the things our team can help you with, earlier we saw someone mention, I think it was Lucy mentioned Stephen Alonso helped build a great policy. That's what our whole team does. We're all dialed into this. So for everyone that said what I would encourage you to do is book a call with someone on our team, and we'll map out your debts, bring your debts to the conversation, and we'll help show you how this process will solve your debt problem. And then there may be some of us here that maybe don't have debt, you're ready to get into investing in something like, and understand. We have some tools to kind of show that. So if you're an investor, same thing applies. If you want to see how this process works, we have some tools to illustrate that. And then I imagine there's a lot of folks here that either own cars today or are going to be buying one to replace the car they have within the next 5 years. And the cool thing about that is what Chris mentioned earlier in this conversation is, would you rather go get that financing from a bank or a dealership and then pay them all the interest? Or would you rather structure a system where you can be your own bank and keep control of that money? So these are all the things we do. There's more, but anyway, just wanted to introduce those, that for anyone that's here new, these are the types of things we can help you do. But we need to also figure out how to design the policy that's going to be part of this solution.
I just got to say, today, the chats are on fire. I don't even know what pantaloons are, but this is getting fun.
An antaloon? What is that? Oh, they're pantaloons. Oh, tailor your pantaloons. I kind of remember those. Shauna, were those big like balloon pants the break dancers used to wear? Anyway, I don't know. So, pants. All right. So, Chris, do we want to go through this glossary? Because we have a lot of new folks. And
I think if anyone wanted this, we could just share it with them if they wanted it.
Yeah. So the one thing I do want to mention just on the glossary is for those of you that are new, we're going to be talking about these things called splits and base and paid up additions. And the real important thing to know out of there is when you pay a premium to a whole life policy, typically, if you're walking down the street to, say, State Farm, Prudential, you walk in the door and say, hey, I want one of those whole life policies. They'll take your full amount of your premium and put it into what's called the base. And we're going to show an example of that. What we do as part of the customization is we take that premium and divide it into pieces where some of it buys the insurance, some of it's going into a cash value rider, so there's some different terms that I just wanted everyone to be aware of. But happy to share these out if someone wants them. But before we get into some of the meat of it, let's go through a couple examples. And these numbers are I just kind of pulled these out because these are kind of consistent throughout the use case. So let's assume you are paying $10,500 in total premium into your policy. However, this policy is one of those traditional whole life policies you might get from State Farm or Prudential or whomever that doesn't know how to do infinite banking. That means that 100% of your premium is going to buy base. Now, who can tell me what's going to happen to the cash value when you have an all base policy? Anyone out there? I know we have some folks like, Chris, okay, you go ahead and tell me what's going to happen if I have a policy like this. What's going to happen to my death benefit? What's going to happen to my cash?
You're going to have lots of death benefit, and you're going to have no cash in the first year, and barely any cash in the second year, and barely any cash in the third year, and maybe the fourth year you'll have a tiny little bit of cash, and fifth, a tiny little bit more. But you're going to have death benefit.
So if I have one of these things and I've had it for 20 years, is it still good for infinite banking?
Oh, sure is. Got lots of YouTube videos on my old policies, 15, 16-year-old policies that are all base. You were talking about MC Hammer earlier. Yep, that kind of base. All base, baby.
So the good news is if you're out there, you've had one of these for 15 or 20 years, it's probably very efficient at this point. but it's not how we would start from ground zero for building this up.
That would be the base. That would be the car without any modifications. That's your base Ford Focus. Boring.
Yep. So let's talk about a 50-50. What do we mean by 50-50? And when I'm showing these numbers, I'm always putting the paid up additions / base. So when you see through the examples, we're talking about 50-50, it means 50% of your premium. So 50% of that 10,500 is going to the paid up additions, 50% is going to the base. Now, some insurance companies will split this up differently where they'll take some of the term that's required to keep the policy from going into what we call the danger zone or the taxable danger zone. And they'll take some of that term and put it in the base, or they'll take it from paid up additions. So why do you see yellow here? That's because there's some term insurance required in this design to keep it from being a taxable entity. Okay. So you take that 3,500 plus a 1,600, that's the 5,250. All right. So that's a 50-50. And then we've got a 60-40. So you guys get the idea. We would take the 6,387 plus a 1,700. That's 60% of the 13,500 premium. These are different suspensions. These are different lengths of your pants. These are different waist sizes. These are all the ingredients that we're talking about when we do policy designs, right? If somebody were to come to you and say, hey, I'm not going to do infinite banking. I just want some protection for my family. I'm going to use the policy for retirement in 40 years. I don't plan on using a penny of the cash value. What kind of design would you do?
Gosh, I would probably still run a few different designs to see which one worked out the best. So I would not tell them I know what design is best for them. I would run the math.
Yep. So we might be a little heavier on the base in one of those, right? As opposed to getting cash value up because we're not going to use it, right?
That's true.
All of these things, when you have those strategy calls with our team, we're going to be asking those questions, understanding what you're trying to do, what's your situation. But this kind of sets the table with what is a 50-50, what's a 60-40, what's a base, all base. All right. So here's the danger zone, the taxable danger zone. And we also have the tax-free growth zones. So let me ask you, if you had a policy design, where would you want it to fall within? Do you want it to be in the taxable danger zone, or do you want it to be in the tax-free growth zone?
Well, I definitely want to go tax-free.
I think we have some green zones, tax-free. So here what it looks like is when we're considering premium and dumps, just know that premiums can go up, dump-ins can go up, premiums can go down, dump-ins can go down. And what we have to do as the tailors of these policies, or the speed shop building your policy, as we have to figure out where those limits are. I know Brent and some others mentioned $1 under MEC. That is one way to design the policies. We just keep driving up the ratios until we hit that MEC, and then we back it off a little bit. But just know when we're doing these types of designs, the premium and dump-ins can be up and down, but they have to work together. It has to almost be like you've got a symphony, you've got the drums and the trumpets, all these things have to work together to make the music to stay in the tax-free growth. So here's one example. And this is based on a 45-year-old male on a 50-50 split. If we did a $10,500 premium split on 50-50, we could get away with putting in a $100,000 dump. So what is a $100,000 dump? What does that actually mean? So if you're starting your policy, you would be able to do an immediate funding of $100,000, and then every year you would be putting on $10,500 on top of that. So now here's the thing, I put a gold star on there because we're pushing the limits on this 45-year-old's policy, where if I do any more dump in, I might get in the danger zone. Or if I go below that 10,500 and try to keep my dump in the same, I'll be in that taxable danger zone.
Greg, I got a great analogy. For any of you that ever watched Days of Thunder, this right here that you're seeing would be that part in Days of Thunder where he's got the pedal to the metal, it's floored, the thing's revving out at about 8,000 RPM, but the motor doesn't blow. It holds together all the way around. If we push it any more, we're blowing the motor. You remember that part of Days of Thunder?
Yeah.
Love that freaking movie.
Yeah, I'm just kind of laughing at Sam's comment here. Bugs Bunny. Yeah, what's up, Mac? Jeez. We got some comedy going on today.
That's good stuff.
I love it. So let's take a look at that and see if you were to say, hey, I want my premium to be at 10,500, but yet we bump that dump in into 105,000. Guess what we've done to the policy? Just like Sam says, we've turned it into a mech, you know. What's up,
Yeah,
mech?
that's where Tom Cruise in the movie was just not feeling it, and just to get out of the race, he blows the motor.
Yep.
Just a little bit more, and he blew the motor.
Yep. So here you've blown your motor because now your policy will be taxable and the IRS will be sharing in the gains of your policy. So the one thing I want to say is if we're holding our premium steady and we start bumping up the dump in, guess what? We're going to go into that danger zone. And at the same time, if we keep the dump in the same and we start lowering the premium because we don't want to pay as much premium, we could go into the danger zone. So there's a sweet spot in here, and that's what we're doing is we're pushing the limits. I mean, we can get to maybe this would take $101, dollars, but that's kind of what we're doing is we're pushing right up to these limits before
Most efficient way you can do it. Yep. It's just that sucker's purring, man. She is happy, healthy. The motor's not going to blow, and it's going to make the race.
Yep. This is a very fast car. It's optimized for that track. So as we go through this presentation, just kind of keep these concepts in mind of what if I push my dump in? Well, I might break it. What if I try to drag my premium down? I might break it. And so these are the things that we're working with. Now there's some other elements inside of the policy here that age, the approval ratings, there's a lot of other ingredients here. And so that's why I'm saying this is on a 45-year-old male, good health, standard health.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
All right, so let's go through some use cases here. And just so everybody knows, we are doing this with a specially engineered policy from a mutually owned company that pays dividends. So this is not an off-the-shelf, just walk down the street, get a whole life policy. But I am keeping them at a standard non-tobacco rating, so it's not as if they're in the most excellent health. They're kind of in the average. And we're going to take our paid-up additions and continue to, if you want to think of it, reinvest back into the policy so it keeps buying more and more insurance, creating more and more cash value. So that's the policy that we're dealing with. Before we jump into the speed shop policies, what I wanted to show, and Chris and I were kind of talking about this earlier, is this is a traditional whole life policy. And this would be, if you were to put $10,500 of premium in every year, this is what your cash value looks like in year one. Goose egg, zero, nothing, okay? But look at, the death benefit over here is $605,000. And so as we go through this and I show you some other designs with the same amount of funding, you're going to see the death benefit dropping. So this has got big death benefit, no cash value. So we put in 10,500 and we don't have anything to use.
Now, let me give a warning on this. Like I just got a call the other day, I don't know how people get my number, but it was a call out of nowhere and somebody called me. They were working with their Northwestern agent, great life insurance company, mutually owned, all the right makings of an insurance company that should work for IBC. And he was saying, like, he had his agent running all these things. He's watching my videos and he's like, none of these look like the ones you're doing. Like, what are we doing wrong? Or like, he couldn't figure it out. He thought what I was showing was what was wrong because his agent kept telling him, this can't be done. You can't do that. So I don't know how they're doing it, but there must be mecking the policy. So this is similar to what his agent was showing him. He kept saying, there's no cash value in the first year, no cash value barely in the second year. And he was literally torn because his agent was telling him, this is the right way to do it. And then he's watching our videos and he's seeing the numbers we're doing, like you're going to see in a second. So he was torn. So he called me and I said, listen, let me do this. Let me just have Craig whip up a couple designs, to which you did 3 of them. And we sent them over to him. Night and day difference, folks. I mean, not even similar. And I kept telling him on the call, I kept saying, listen, it's not your advisor's fault. They're just not trained how to do this. This is so specialized, so difficult to do. We've just done it thousands of times. So this is what you're going to see if you go to a regular life insurance agent or a financial advisor. They're either going to show you something like this, or they're going to try to sell you an IUL, because that is the highest paying commission on any product right now in the industry.
And this is really when you hear the opposition to infinite banking, whether it's Dave Ramsey, Suze Orman, whomever it's going to be, they're talking about designs like this where, why in the world, Dave Ramsey yells at everybody, why in the world would you put $10,500 in? You got no cash value. What are you, stupid? He just goes crazy yelling at people. I'm like, wow, I'm calling in for advice, but you're going to scream and yell at me. So, by year 2, you've put in $21,000 and you have $345 of cash value.
Does anyone want one of these? By the way, does anyone want one of these policies?
Bueller?
Okay. Bueller. No, thank you. Oh, look at how pleasant they are. No, thank you.
No, thank you.
All right, good. Because we don't do these policies.
Yeah, so this is the thing, and what we do when we're looking at policy designs, these are just some of the, when we put it on the dyno machine or whatever you want to use for the car analogy, there's 2 things we're really looking at. One, I really focus on the most is this thing called cash on cash, because what we're measuring here is on a year by year basis. I want to know when I put $1 into the policy, so I put in 10,500 and I have no growth. Well, what's my cash on cash? Well, it's 0. I have no money to use. In year 2, we're putting in 10,500 and we have $345 of growth. That means I've got about 3 cents of every dollar back. Year 3, I've got about 75 cents of every dollar back. So it takes me almost up until year 7 before I get $1 back, which means we put in 10,500. And let me just do this because it's probably a little easier to see. If by year 7 we put in 10,500 and I have 10,503 of growth, that's where I'm getting dollar for dollar back at that point. So that's one of the efficiencies that we'll look at. And then the other one we look at is this cumulative column here, where we're trying to gauge at this point,
wow, 16 years.
How much. So if I added all these premiums up, it means by about year 16 to 17 is when we've gotten all of our money back that we put into the policy.
But right there, hold on. Let me just say something. You're all going to see that this is terrible for what we now know how to do. But think of it this way. Like Dave Ramsey, I'm going to go back to him. Dave Ramsey's always saying buy term, buy term, buy term. Term is the most expensive life insurance you'll ever buy because only less than 2% of all the policies ever pay out on the death benefit. But you still pay premiums every year, although the premiums are cheap. So you got to understand cheap. Do you buy the cheapest clothes? Do you buy the cheapest food? Do you buy the cheapest anything? No, nobody wants to buy the cheapest, but that's what term is. But term still has a cost that is a true cost. Here, even in a 100% off-the-shelf whole life policy, by year 17, I think, year 17, you have literally gotten every penny back that you put in. So you literally could get all the money back. This would be like buying a term policy that has a premium refund, which those are very expensive, so you would never buy one. But that's what this would be. You got all your money back, but yet you still have a $600,000+ death benefit for the rest of your life. So I'm just trying to show you apple for apple. When people are like, oh, buy term, it's cheaper. Do you want cheap or do you want the best? This is a normal whole life and you still get all your money back. I think that's an important thing to realize. It's only going to get way better from here, but I just thought I'd bring that up, Craig.
Yeah, and it's a really, really important point because by year 17, if you think you're going to live longer than that 17 years, then why wouldn't you want something like this where you've got all your money back, plus now your family is protected with over 600,000, and it just keeps getting better and better. So still a really good tool, but can we make it better? This is the forward focus. Now what we want to do is start modifying that forward focus. So let's say, for example, and Chris, when you were talking about that fellow we were working with where his Northwestern Mutual guy said, you can't do this, you must be mecking the policy. The other thing we hear a lot is that you cannot dump money into a policy like this. It would be a taxable entity right away. So when we're showing you this design, what we're talking about is putting $100,000 into the contract immediately and then a $10,500 premium every year. So you'll see there's $110,500 going in year one, $10,500 going in for the first 7 years after that. This is just another thing in the industry that if you don't know how to do the infinite banking policies, you don't understand that you can dump in money. And why would somebody dump in money into a policy? Do we have any examples you can think of, Chris?
No, a million of them. They got money sitting in a bank account that's paying them hardly anything because they didn't find PMC wealth. The money's, just sitting there for a rainy day, an emergency fund. It's a business and they've just got money in reserve accounts, or tax accounts, and the money's just laying around doing nothing. A lot of reasons why people would just have money or laying around. And it might not be 100, it might be 10 grand, 20 grand, 30 grand. I mean, we're just using 100 just for an example, but most people have money set aside for an emergency fund or just that opportunity fund.
Yep. So there's some good comments, like Celeste mentioned, inheritance,
tax refund. That's a good
consultants
one.
fees, tax refunds. So, that we work with real estate investors that are running money through policies. Sometimes they sell a deal, they have money to put in the policy, pull out. We have folks that might have some savings sitting around that they're going to use for debt, run that through the policy. So dump-ins are a very valid way to immediately get cash value building in your policy. But in this design, what we're doing is a $100,000 dump-in, $10,500 in annual premium on a 50/50. So remember, the 50/50 is we're taking that $10,500, breaking it into part base, part PUA, and term. And this is a design for that 45-year-old, 44-year-old that's pushing the limits. Remember, we're staying in that tax-free green zone. If I start changing those numbers a little bit higher on the dump in, or if I lower the premium, guess where we go? All of a sudden I'm hearing the danger zone from Top Gun, but yeah, we're going to the danger zone. So let's take a look at the efficiency of this one. So you put in 110,000. What's that?
I just said, open the hood.
Yep. We're going to open up the hood. We're going to look underneath the car. We're going to check out the suspension here. So as compared to our previous example, we're putting in 110,500. We immediately within the first, well, actually, to be fair, this is at the end of the year because it's considering the dividend, but we have 102,187 of cash value, which means we have a cash on cash, or we have 92 cents of every dollar back already at the end of year one, and a death benefit of 1.5. Now, some of this, and I'll get to this in a minute, but some of this is term insurance. However, who would rather have 92 cents available within the first year or nothing compared to the previous one? And the crowd should be going wild saying, I want 92. I want 92. Yes, there we go. Now, here's what's really cool. We talk about this thing called the money tree. And I think Joe on our team, coined this phrase, the money tree. What we mean by the money tree is when you put in 10,500 in year two, you had $12,097 of growth. That means you have $1.15 back at the end of the first year. This is what Joe coined as the money tree. I just have always called it the efficiency point, but I like the money tree. So by the end of year two, you're already getting more money back on a year-by-year basis than you've put into the policy. And I think Lucy was mentioning earlier that her son got a policy and year two was the money tree. That's what she meant right here. So that's pretty cool. The other thing we're looking at is the cumulative. So in this policy, we've already gotten all the money back from the policy by the end of year 5.
Dude, Dave Ramsey, eat your heart out.
Yep. Dave Ramsey's driving around in his Ford Focus with a broken window, and we just went by, and what was the guy's name that does the racing?
Ken Block?
Yeah.
Ken Block would be like doing donuts around him while moving. At any
he's doing circles as he's going down the street. So this is the 100K dump in, 10,500 premium 50/50. Really, really strong policy performer when you start doing big dump in, smaller premiums. Now, something else that we talk about on our strategy calls is what happens in year two if you don't have 10,500? Well, there's a minimum portion here, and I'm just going to say it's maybe 7,000 because I don't know that it could be this 8,822 actually. But you could go anywhere from the 8,000 up to the 10.5, or depending on how we design it, you could almost put the dump in again, year two if we designed it that way. So the other thing to remember is this is can be a very flexible setup where you might have a Ford Focus, but then you get to the lake and all of a sudden you've got the ability to drive on the lake with, floaters on the side. So we can do some other customizations of the policy. But there's always a minimum and a maximum. And so this minimum would probably be around 8,000. So you could do 8 or 10, somewhere in that ballpark. All right. Any questions on this?
I just want to add one thing, Craig, and as they post the questions in, another thing that, is a common myth. It's not really a myth because it's correct. So Dave Ramsey always, on all of his shows where people bring up whole life, he says, the cash value, you don't get the cash value and the death benefit, to which he's correct. So Craig, can you just grab a marker? I just want to circle two things here. I want to just look at the cash value in the policy. Okay, and you can just go to year 10, doesn't matter what year, or 11, or whatever we want to do. Yeah, so right here, cash value is 241,734. What's the death benefit? 484,62, because we dropped the term at that point. So what Dave Ramsey's saying is that when you die, you don't get the death, or you don't get the cash value. So he's right. Your projected death benefit is 482,622 if you die, and you have 241,734 when you're living, okay? So what he makes a huge deal of is he says the cash value isn't increasing the death benefit. To that, he's wrong. I want you to just look real quick. Just go 1 year. The next year, you put a premium in of 8,822. Your cash value goes from 241 to 261. I mean, sign me up. That's a $20,000 increase for putting in $8,000. You take out $20,000. But look at the death benefit. How much did the death benefit go up? I mean, it's not dollar for dollar, but it's almost 20 grand, isn't it? Everybody seeing what I'm seeing? You went from 484 to 508. But Dave Ramsey says your cash value doesn't increase your death benefit. Dave Ramsey's right. See, Dave Ramsey uses his limited knowledge or his book knowledge of whole life and calls it the gospel. But what Dave Ramsey is forgetting here is that these are mutually owned life insurance companies to which you get paid a dividend. In the 11th year, you got paid a dividend of $10,234. And we have this policy set to reinvest that $10,234 into paid up additions. So that $10,234 goes to the cash value, increases the dividend for the next year, and increases the paid up additions. And the paid up additions, by sheer nature of how they are constructed, have to buy additional life insurance, because in order to keep this policy growing, which it does, and it grows very quickly from this point on, the death benefit has to always remain higher than the cash value. So as the cash value goes up, that increases the dividend and the compounding effect of the interest, which then increases the death benefit through paid up additions. So Dave Ramsey never explains that. But as you can see right here in the flesh, it is happening lock, stock, and barrel. And to go even one step further, go over to the guaranteed column. The guaranteed column even increases the death benefit. So as the cash value goes up, the death benefit goes up as well. Not as fast, but it's still going up. And there is no dividend accounted for in the guaranteed column. So Dave Ramsey, I just want you all to know, like, he does a great job with his baby steps program. The dude just needs to shut his mouth when it comes to life insurance, because he just does not understand any of this stuff at all. Sorry, Craig, I'll let you continue. That was just an important thing I wanted to point out, because a lot of people are like, well, do we get the cash value and the death benefit? The answer is no, but the cash value increases the death benefit almost pro rata, but not exactly.
Yep. Yeah, and those are all great points, because those are all the talking points of what people's minds are filled up with that are the mistruths, the untruths, I guess I should say. But before we go on, one other step is there may be some folks wondering, why in the world did the death benefit go from 1.6 to 439?
Oh yeah, I wonder if they knew that.
So this is the term insurance. We were talking about staying out of the danger zone. The IRS wants to see a certain amount of death benefit for the amount of money we're putting in on the premium side. So we have some temporary term insurance that we put into the contract so that we satisfy the staying out of that danger zone or that taxable entity. So that's why it drops here. That's all part of design. If you wanted it on longer, we can keep it on longer. Those are all just design considerations.
Awesome. And Craig, I'm going to pause you right there, because we're going to go into some super cool stuff, and I want to flip this over. So folks, like, one of the things that I take pride in, and this whole team takes pride in, is our live events. Like, we do a lot of these live webinars like this, where you get to see me and Craig and Steven through a camera. But like, how many of you have ever wanted to just hang out? maybe have a dinner together, maybe go to a really cool like medieval dinner where we watch like some awesome, I don't even know what they do, but so like what I've really had a lot of fun with is going to events and meeting the people behind the screen. So all these folks that we're laughing with, we're talking to here, all the new folks, like I love doing these webinars, but I more love meeting people in person, building relationships, building memories. And we've got these events that we do. They're called the PMC Money Tank events. Most of our campfire, our community knows about them, but there's a bunch of new people here. So Stephen, can you just explain about the next money tank that we've got going on? I just got back from Dallas, Texas. I love Texas. It's awesome. So we're doing this event in Dallas, Texas, easy to get to from everywhere. And also the venue is just awesome. So Stephen, kick off and tell them a little bit about PMC Money Tank in the next one we're doing in May.
Yeah, definitely. I mean, so if you've been around our campfire, you guys have heard us talking about, we're doing, less live events right now, just, with life going on with our children, families, travel's been, difficult. So, in the past we've done, a dozen live events each year where you could come out, and we're really limiting that right now. And really probably we're only going to have 2 more live events this entire 2025. And this is going to be one of them coming up in Dallas, Texas, May 8th and 9th. So we are going to do it on a Thursday, Friday, which is a little bit different. Usually we'll do a Friday, Saturday or Saturday, Sunday, but that is Mother's Day weekend. So we wanted to get some business in and then make sure everybody can get home to their, mothers or, however you want to celebrate that weekend. So it is a Thursday, Friday. Keep that in mind, but it's going to be 2 jam-packed days, and we'll probably end up doing something that Wednesday evening also. So if you can fly in Wednesday afternoon, be expecting to meet up Wednesday evening. We always get together before the event starts, get registered, get our name badges, everything set up. And then this event's going to be really, really cool also, Chris, because unlike money tanks we've done in the past where everybody kind of stays at different hotels and we have the event in like event center, or the last one we did was at the Charlotte Motor Speedway, for example. This money tank is going to be, we're staying at the hotel, the event's at the hotel, we're going to be meeting at the bar at the hotel afterwards and hanging out the whole time right there. So it's very convenient. And then Chris, I know you'll be there with myself, our team. We're bringing in a bunch of experts and coaches, people that are very high level real estate investors, own hundreds if not thousands of properties, and they're all going to be there the whole time with us together. And so it's going to be an incredible event. We're going to get very educational with it. So if you want to learn how to get into either side of real estate investing, either active real estate, passive real estate, whether, depending on what your goals are, if you're looking to really accelerate your wealth and really create some cash and create some money, or if you're looking just to take the money you have and get that to work, maybe get it out of the stock market right now at all-time highs, maybe take control of it. What do you do with it? Keep it, private money lending has been a great strategy for a lot of people right now, especially in this economy and, especially going into 2025 right now with everything going on with the market. So it's going to be invaluable education. The timing couldn't be better for it. So May 8th and 9th in Dallas, Texas, it's going to be a lot of fun. If you do the VIP, I'd recommend it because Thursday night, we're all going to go, all the VIP. It's limited to 40 people. So the first 40 people to buy VIP will get this. But we're all going to go, the VIP students, as well as Chris and myself and our executive team, we're all going to be going to medieval times. So if you've never been to one of these theater dinner shows, they're really cool. It's kings versus queens, and they have the horses. And we did a really cool thing where they're going to bring some of us out there with them. And anyways, it's going to be really, really cool. I'll leave some of it for a secret, but definitely go to that. And we do have, I guess I can share this. We do have an early bird special going on right now too. So, and I'll put this in the chat box, but just so you know, if you want a general admission ticket, the coupon code is early bird 1. So early bird, all one word with the number 1, early bird 1. And if you want a VIP ticket, it's early bird 2. So early bird 1 or early bird 2, depending on the type of ticket you want, and that's the largest discount you're going to receive on this event. That gives you the premier member discount, the early bird discount, as well as the pre-price increase discount. So it's the cheapest it'll ever be right now. I think those prices are going to go up in something like 2 weeks. It should say on the page actually, Chris, if you scroll down. But the early bird discount will go away very soon, and then the purchase now discount will go away next. and then the premier discount will go away after that. But anyways, get your ticket now, get it locked in. And once you register, we'll email you the room block so you can schedule a room. We have discounted rooms. They're actually really, really good deal on rooms. If you get a rental car, it's free parking actually. So a lot of really cool perks going on. And at the end of the day, though, Chris, it's just going to be an awesome event with our team. And one of the few times this year, you can have an opportunity to come hang out with Chris for a couple days, myself and our entire team. So that said, I think.
Am I doing early bird too? Oh, that's why.
That's for
I
the.
got, yeah. I'm just trying to show everybody like doing this. Everybody can see this, right?
Yes.
Just showing you how
I've
much.
I've got the website up right now. Do you want me to stop sharing?
Look at that. No, I think I'm sharing. You can see my screen, right?
Yeah, we see Chris's.
No.
I took over. So look at that.
So
You
it takes
saved
it like
600 bucks.
50% off. Is that 50%, 45% off?
Yeah.
I mean, it's
Yeah.
a really, really big discount. I mean, barely.
$600 savings on VIP. So that's huge. But this is definitely going away because I can't lose that much money on this event. These events are definitely costly. No question about that. All right, Craig, back at you, bud. Thanks for letting us do that, folks. It's just important. Like a lot of times people are like, hey, you never told us about the event. Well, now we're telling you.
Exactly.
All right.
Back
So
to the
before we
regular
go,
scheduled program.
yes, back to the regularly scheduled program. So it's almost like a commercial break. Thank you for the commercial break. So before we move on to the next step, I just want to tell a quick story because this was a lot of what was put together was based on a real situation. And so someone in our community already has some policies, wanted to start another one, came to me and said, hey, I want to be able to put 100,000 in, 10,500, somewhere in that 10 to 12,000 range. So the policy was designed this way with a 50-50, and there's so much noise out there. They came back and said, well, that looks great, but why in the world would you do a 50-50? Because I've heard the 90-10 is so much better. And so remember that chart where we're showing the danger zones? We can't do a 90-10, but I wanted to show the benefits and the disadvantages of moving the dump in down, the premium up. And so this next piece is really what this is about. So imagine, if you will, we're going to keep the dump in at 100,000. So that's not going to move. The dump in is going to stay at 100,000. If we do a 50-50 design, meaning 50% goes to PUA, 50% goes to the base, we've already seen that 10,500 will work. We'll stay in that green zone. But if we do a 60-40, what's going to happen is we now need to add more premium and because more of that's going into the cash rider. So instead of a $10,500 premium, I need $13,500 on that 60-40 design to be able to put 100,000 dump into the policy. So do you see what's going on? We just keep going up and up and up in premium as we drive those splits up. So if I did a 75-25, which is 75% PUA, 25 base, we now need almost double. We need to go to over double. We need to go to 23,000 to be able to keep it from going into the danger zone. So here's the thing. When he came back and said, hey, I want a 90-10 with that $100,000 dumping in the 10,500 premium, it just isn't going to work. I need the premium to be 90,000 in order to have a $100,000 dump in if I do a 90-10. So now you start to see that there's a lot of other things to consider in here. There's no way to do a $100,000 dump in and a $10,500 premium with a 90-10. It would be a modified endowment contract. It would go into those danger zones. So this is one of the big things that I hope everyone can walk away from today is don't worry so much about these splits. And I'm going to go back to what Brent Burdick said earlier. He said, hey, just give me a policy, $1 under the MEC. So once we understand how you want to fund it, what problem you're trying to solve, we will figure out these splits and figure out just how to push that, push it right to that danger zone. All right, so let's go on and take a look at this next piece, because I just wanted to illustrate as we play with the premium and we play with the dump in, we've already seen the 10,500 premium on a 50-50 works, right? We stay in the green zone. If we do a 13,500 premium on a 60-40, we can still stay in the green zone with that 100,000. So just know that when your money mentor or whoever's helping here says, you know what, I can't do 75-25 with that mix. We're either going to have to bring your dump in down, raise your premium. We're not doing it because we don't want to give you a 75-25 or we don't want to give you a 90-10. It's all based on us knowing the type of car you're building and the type of track you're going to be on, and just be able to, derive the best cash value for your specific situation. So hopefully this visual makes sense. Chris, I don't know if you want to add anything to this.
No, there's really very little to add. It's just, this is what, what I didn't know when I talked to that guy from that other IBC place that only does 90/10s is this. I wasn't aware back then that you literally couldn't pull it off. It just is impossible. It's not even possible until I met that guy and he said, no, we don't actually do all 90/10s. It's not possible when there's a dump in. We didn't have this crazy danger zone template done. So this is where, like I said, this is the first time we've ever shown this, and Craig put this together. It really just gives you guidelines of how to build the best race car, the best IBC policy for your needs. And again, there's no one of these that's right or wrong. There's just what one is right for your need. And a bunch of you already got that right earlier.
Yep, absolutely. So let's continue on, and I just want to show another aspect, because there's term insurance. Remember when we looked at that 50/50 and we saw the death benefit go from 1.6 down to 400,000 or so? Term is part of the equation. That term insurance is part of the equation. But I was sitting here mulling through, looking at the numbers. I thought, I want to show some way how term interacts with the splits and the cash on cash. And so as Chris and I kind of noodled through this, we see some pretty interesting insights in that the 90/10 has the highest term cost. That's what the blue bar is how much term am I paying? And the term costs are over here. So it's probably somewhere in the $2,700 a year in term cost to do this 90/10. We're also measuring that money tree, that cash on cash. So when I put $1 into the policy, when do I get $1 back? Well, the 90/10 is pretty close to that 100%, but we see a higher efficiency as I start dropping as I start, going to 75/25 or a 60/40. So here's the thing, the 50/50 has the lowest amount of term cost. It has the highest efficiency in year 2 of all the plans. And not to say that this 50/50 is the best one, it's the best one for this specific design. But it was interesting to see how the cash on cash drops over time with the term being higher. That's just some of the...
It's almost like, it almost messes with your mind, because your mind wants to think 90/10 is the best, but with a dump in, it's not, because you have to have so much base on the policy to do it. And the term cost, literally, I know term is the cheapest, but in this case, because you need so much more of it, it's not cheap anymore. It's actually pretty costly. And that cost for the term is a complete waste. Like, unlike the cost for the base, like even the base has a cash value component and grows. So the 50/50, what you're doing is you're getting that perfect blend of base to PUA, and you're minimizing how much term you need. And because of that, your costs are managed well. The efficiency of the policy is right in line, and you're getting just the most efficient design because you're having the most amount of money put in for the least amount of premium deposit. This is something that if somebody told me this 4 years ago, or maybe even 3 years ago, I would have said, no way possible. No way, you're an idiot. There's no way a 50/50 is going to beat a 75/25, until spreadsheets came out. I think spreadsheets came out a lot before, or way before 3 years ago.
We've been doing a lot of number crunching, and Chris, Steven, our whole team, we get together, we just think about these things and how else can we prove and show it. But this is, at the end of the day, this is the math, folks. So the 50/50 is not always the best. The 90/10 is not always the best, but this at least gives us some guidelines of where some of those efficiency marks are. But to me, looking at if I'm trying to get a $100,000 dump in and minimize my premium, this is the best. This is not the best. So it's all going to depend on what you're trying to accomplish, but it's just interesting to see the term costs going higher, efficiencies dropping, the lower PUA on the 50/50. So it all works in conjunction. So this to me is a beautiful concert song up here. So
love it.
So let's take a look at some other things here. If anybody wants to look at the numbers, we can, but this is just the table with the 13,500 premium, $100,000 dump on the 60/40. Same thing we've been looking at. We still have a money tree at year 2. cumulative at year 5. So I'm not going to go through a lot of this detail, but you can see that the term cost is a little bit higher on that. So I'm going to jump through these unless there's any questions. Chris, did you want to do any focusing on this 90-10? I know you and I were talking about it before the show a bit.
Yeah, I think the most important thing, like one thing that I did, and before we went on the show, one of the things I had is I had multiple screens up. So I was looking at different things, because right now we're showing you one screen at a time. So you're probably like, wait a second, I want to see them and compare them. Well, we did that. And the one thing that I was very surprised at is the 90-10. You know, even though you're putting $90,000 of premium deposits in versus the 10-5, you know, to get the 190, like when I looked at the cash on cash return, the cash on cash return did not beat any of the other designs. The cash on cash, which is the ultimate measure of efficiency within these policies, and 90-10 should, by all intents and purposes, the lowest commission should be the most efficient, and it was not. I can't remember where it was more efficient, but it was way down, and it wasn't even a big difference. Plus, I had to fund this policy way more. So like this is out of line for most people. So the only way they could change this is reduce the dump in down significantly if they wanted to get to 10-5. So I just thought this was eye-opening to me. And I think that's why you brought it up, Craig, because it definitely even defied with what I know. It even defied what I wanted to think would have been the case. Because I said to you, Craig, I said, the 90-10, yeah, I know it's not going to be as good in the early years, but it's got to catch up eventually. It almost never did.
Yeah. And the downside is, to your point, I mean, you're kind of putting in this 90,000, but you could drop that down to the base, you know, to be fair, but you know, you're still funding it at around 90,000 to get this performance. So let's just do a quick spot check. At year 10, it's 157 in cash on cash. I am just going to go back up to the 50-50 real quick. So 157 at year 10. Probably should have just drawn some of this stuff out, but
it's all right. People get to see it because this is how they would do it.
So year 10, we're at 216 on the 50-50.
It's a big difference.
Yeah. So interesting that, you know, there's still quite a bit of difference. And, you know, as we go down, it's, you know, keeps going up and up. But let's, to your point, Chris, and this is one of the things we want to look at is, what if we now shift it to say, what if we want to keep our premium the same, but we're going to start modifying the dump in? So we started out keeping the dump in static and modifying the premium to meet that dump in. Now we're going to shift it the other way. All right, so drum roll. We're keeping the premium fixed at 10,500, and we're going to be changing the splits from 50-50 to 60-40, 75-25, 90-10. And of course, on the 50-50, we can get the full 100,000 in. On a 60-40, we have to drop the dump in down to 76,500. On a 75-25, we have to drop it to 43,500. On a 90-10, we have to drop it to 14,000. This is pretty wild, just to know that, you know, as you know, when I was thinking about with this person I was working with, and they said, hey, I want to do the 10,000 dump in the 100,000. I'm sorry, the 100,000 dump in the 10,500 premium, but I want a 90-10. Do you see what we're talking about? There's no way we would get 100,000. We can only put in 14,000 and dump in, or it goes into the danger zone. Does anybody else see that? Just like, it's just wild to me.
This happens all the time. We get clients, you know, that get on a call with us and we're kind of going through to solve their problem. And they literally tell us, hey, I only want a 90-10. And we're like, yeah, no problem. I mean, we'll do what you want, you know, oh, but I want to dump, you know, and then they give us their numbers. You know, I want to do this dump in and this. And like, this is what we have to tell them. You cannot do that. It is not possible to do that. Otherwise, your policy will mech. And then I hear all sorts of crazy things. Yeah, well, I'll just have a trust own my policy then, and then it can be mech'd. I heard that from this guy on YouTube. I'm like, yeah, you might want to call a tax attorney and consult with them before doing anything like that, because you don't know the ramifications. Once that policy is owned by that irrevocable trust where you can mech it, now all of a sudden you're not taking that money out for any personal use. So that is only to be used within that irrevocable trust. So if any of you have seen any of these, there's one Yahoo out there in the IBC space. He's toxic. I just did a short on him, but he's a bad man. And he's out there slinging these trust structures. He's out there saying he's selling policies by saying, put them in a trust and you can mech it and it's going to be this and blah, blah, blah. Folks, I'm not going to say whether that is true or untrue, but all I'm going to tell you is I consulted with a tax attorney, and I don't think any of you would like to hear what the tax attorney said. But you know what? I'm not going to give that away. You guys can do that yourself.
Yeah, so
Very important.
as we talk about designs, it's just being aware, and like I mentioned in the beginning of this presentation, these numbers might be different for you. Maybe this is 16,000 or 20,000, but the concept is the same. As we increase that PUA based split, something's got to give, your premium or your dump in. And so this is just the picture of the danger zone. And I know Tess has got that song in her head as well as I do. But in the danger zone, you know, we have a very small tolerance on a 90-10 in between the premium and the base. As we turn that down to 75-25, 60-40, 50-50, I almost want to get like a volume knob where we can kind of play with these numbers, but the 50-50 is going to give us the best use of the whole spread here, if you will, from 10,500 to 100,000.
I think this whole presentation, this whole education piece here is essential, because I think, you know, we're getting on the calls with a lot of people, and we talk to hundreds of people a week, maybe even thousands that we talk to, but we move forward about 300 to 400 people every single month in terms of getting policies, and we're trying to do what's best for them, but they're just getting information from lots of different sources. So what we're telling them and what they're hearing out there are sometimes different, and this just mathematically brings it together and says, listen, we're probably I'm not going to say this, I don't have any factual data, so don't beat me up if I'm wrong, but we are probably the only IBC centric, meaning that's all we do, company out there that is spending the time, the energy, and all the resources to literally mathematically prove all this. The rest of them are just out there just selling policies. They don't even service the policies when they're done. You know, like if you start a policy with some of the other IBC shops, they're not providing you a mapping or an implementation team. They're not giving you the tools that we do to solve your debt problem, your gains projectors, or any of the tools that we've created. We do that, and we charge you nothing for any of those services because we implement the infinite banking concepts. The other people, they're just trying to sell you a policy so they can get a commission and move on to the next. That is not our goal. We're going to solve your problem, but we're going to hold your hand and walk through that implementation process of that. The only way IBC can fail, the only way this can fail for you is if you fail yourself. That is it. Mathematically, it can't fail. But you can fail yourself. You can be an unhonest banker. You can steal from your bank. And all those things will result in lackluster results. But you can't blame anybody else. It's a simple process. You change one thing, you add one step, you follow the rules, you become an honest banker, and you don't steal the peas, says R. Nelson Nash. But we are out there doing this the right way. And we are really, really trying to set the pace in this industry. And all of you enable us to do that. So I want to thank every single one of you for being here. I want to give you a big shout out for learning and trying to educate yourself and get ahead to take back control of your money, because that is the amazing part. And we would love to be part of that journey. And that can come in many ways. You can join us in MSTV, our lowest priced entry, $19 a month, $190 a year. We put that up. It's moneyschool.tv. That's it, moneyschool.tv. I think I got that right, Stephen? Moneyschool.tv. We got all new domains. You could join us live and hang out and do some cool things like watch, I guess they burn a witch or something like that. Someone said that. Like, I guess we're going to watch a witch get burned while we eat dessert. At Money Talk. Just kidding. But the medieval times, somebody mentioned that in the comments. But you could go and we could have some super, super good times and make some good memories. I don't think there's going to be any witches harmed in the making of Private Money Club Money Tank. But you could join us there. We gave you a 50% discount, almost a 50% discount. Or I'm going to put it up one more time. You could just book a call with one of our money mentors. And somebody said, I'm just going to get on the call to learn. I don't want to be sold. We don't sell. We solve problems. And if we can solve your problem, we already know you're going to ask us to help you. And that's how we operate. And I would love to help every single one of you. My team would love to help every single one of you. And folks, just for a second, can you both put your hands together for Craig and Stephen here? Stephen hasn't said much, but he's been behind the scenes answering all your questions. Craig puts all the math together for all these. So I don't know, you really can't clap. I wish it was a live audience. But you know what? That's why you got to join us in Private Money Club, because then you get the energy. All right. With that being said, Stephen, bring us home on this one.
Yeah, I'm going to talk a little bit at the money tag too, so you guys can't keep me quiet that long, baby. But no, this was awesome today. Great work on the introduction. We were talking a little bit about race cars and all kinds of fun stuff today. Craig, nicely done like always. But I do look forward to seeing you guys get your tickets. These events always sell out, so we like to be able to kind of get it sold out, and then we kind of like to add things and make it more fun, and then we can really plan. So get your tickets for Dallas ASAP. Schedule a call with our money mentors. They're on standby waiting for you guys. So just call them up. Be prepared for the call. So if you have any debts, kind of start getting those debts together. Start thinking to yourself, like if you're married, you have a spouse, family, like talk with your family ahead of time. Like, where are we today, guys? Like, where are we going to? Like, bring your spouse on the call with you. On that call with the money mentor, you can do a video. I mean, we recommend you do a video call. So you can kind of meet them in person. They can see you. It just creates a little bit better of a personal connection right there. And yeah, MSTV is a lot of fun. We have actually Mr. Burr, Devin Burr from Instagram, is going to be doing tomorrow's live TV show at 11 a.m. Eastern. So if you are an MSTV member, make sure you hop on live tomorrow. If you can't, those recordings get put into the MSTV database each week, and we will continue to add and grow that MSTV also. So with all that being said, some of you guys I'm going to see this weekend actually in Tampa. So for the Money Game live event with Hannah Kessler and Larry Steinhaus, I'll be over in Tampa this weekend, Friday, Saturday, and Sunday. So hoping to see some of you guys there as well. But if not, I better see all of you in Dallas, May 8th and 9th. Thanks, Chris.
No problem. All right, folks, thanks for joining us. We're going to hang out for a little bit after just to answer the rest of your questions. But for the rest of you, if you have questions that didn't get answered or new things pop up, join us at 4:30 p.m. Eastern at the happy hour, the Ask Me Anything happy hour. And how you get to that is you either subscribe to my YouTube channel, but you got to click the bell, smash the bell so you're notified, or you can join us on Facebook, YouTube, or Instagram. We'll see you then. Thanks, folks. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.